most important person in the budget is actually you, leadership, right? Whether you're the founder or you have a group, who leads the operations of the business or the strategy of the business. Now, welcome to my channel. Thank you so much for coming to Finance Boulevard. For those who are coming for the first time, we use this channel to promote accounting and finance, talk about everything investing, personal finance, business, and economy. And for those who are returning, thank you so much for coming back. I'm really very grateful. Now, this evening, we are going to be talking about finance for startups. This is basically a continuation of the conversation I had in the last video that I made. We had told you that I spoke to startup founders in Nigeria on an accelerator program called the Pivot Challenge. And some of the things we talked about is basically what I want to share with you. Now, today we are going to be talking about part of those things we talked about. But before I go ahead, I just want to do a quick refresher on the things we talked about the last time. In the last video, I told you that there are a few things that startup founders and startups generally need to know about their finances. One of them is that they need to be able to separate their personal finance from the business finance. Basically, what am I talking about? I'm saying that you need to be able to keep separate records of the things happening in your personal life from things happening in the business. Most times you see that founders typically don't really do that. They think that all of the things, all the monies are theirs, by the way, so why should they even bother? But really, that really hurts the business, because at some point, somebody may actually want to come into the business, either to provide you with additional funding or to do anything, right? And then it becomes a problem. So it's important that if you should differentiate or distinguish your business from your personal finance from your business finance. One of the things we said is important in doing that is that you should be able to pay yourself from the business, and to the extent possible, even if the business cannot pay you the amount you're worth, show that the business owes you, but just show that this is how much the business ought to have paid you, but this is how much the business paid you, and then meaning that the business owes you, right? And then if there are maybe personal commitments, funds you inject into the business, please don't forget to record all of those and keep them separate. We also said that cash flow is important for a startup. It's very, very key. Without cash flow, the business is going to die very quickly. So it's important that as a startup, you are able to, plan your cash flow. Know where next the cash is coming from. Where next, what is your run rate, your burn rate, and then know where how to make sure that you continue to keep afloat. Otherwise, you may not last so long. And we said that while cash flow, while expense management is important, that it's more important that you actually grow revenue. And nobody asks you what percentage of expenses did you, either reduce, did you manage, or did you what proportion of, or what percentage of your expenses did you reduce the last time? Most people always ask you how much your revenue is growing, right? Because if your revenue is growing, they are very certain that at some point, you're going to break even and start making profits. So while it's important to manage your expenses, please focus more on the things, on activities that generate revenue. If it is marketing, if it is maybe quality products, whatever it is, innovation and stuff like that, just focus on that. And then manage customers and all of those things. And then we also said that you need to be able to know some of the KPIs or metrics that your industry is measured on. Don't forget to know those metrics, know them, and then have them at the tip of your fingers. It's very, very key, because you may get into a conversation with a financier or a founder, and then it becomes a problem if you can't speak in that language. So please don't forget to know them. The last thing we talked about the last time is that a startup needs a budget. Everybody needs a budget, by the way. So, but startups really need a budget. Most times, startups really don't do budgets, and that could be hurting. And today is just a quick brief on what startup budget can be. So we're going to be talking about what startup budget is, why it's important, who is involved in it, how often you should do a budget, and then I'll share with you something very small around startup budgets, right? So we are going to just do a very brief budget. I'll just show you what it looks like, so that the essence of this conversation is such that whether you are a one-man business or you run an operation with a number of people, you'll be able to know what to do, and then probably even if you're reviewing a budget, it can help you to know what to focus on. Now, what is a budget? Budget is easy, right? It's just a plan. It's just a plan. Budget is a budget. It's a plan. What exactly you want to do? That's exactly what it is. And then you express it in monetary terms. That's it. So budgets are actually whatever you plan to do over the next 1 year. You can cascade that as much as you can, probably to quarterly or to monthly, and that's it. And just express it in monetary terms. So it could be whatever currency that you are budgeting in. You know. So budgets are important. Why are they important? So as I said, budget is like a plan. It's a guide, right? It helps you to make important decisions, right? It's just going to help you to run your business better, because you have something like a roadmap that is guiding you on the things you plan to achieve, and yeah, budget can change over time, right? Because as you go ahead, you can see some things you didn't consider in the course of your budgeting and all of those things, but it's just a guide, right? And generally, you can also see that it helps you to measure your performance, because when you have basis for measurement, then it means that at the end of every period you can look and say, have I achieved or have I attained some of the things I said I was going to attain, right? That's what the budget can do for you. And then finally, some people actually need budgets. For instance, investors can actually ask you to see what your budget looks like against what your actual operations are looking like. That can be very daunting if you don't really have a budget, because what they want to do is to see whether, historically, the things you say you want to do, whether you achieve them. You know. Now, as I said, who is involved? The most important person in the budget is actually you, leadership, right? Whether you're the founder or you have a group, who leads the operations of the business or the strategy of the business. Now, somebody needs to be able to tell everyone else to say, okay, this is what we want to achieve. This is our goal. And we want to acquire so and so number of customers. We want to reach so and so number of markets and all of those things. That is what this is about. So somebody needs to have that broader view of what needs to be done, and then the budget is just going to condense it and then make it some numbers that people can look at. So most important person for budget is actually you, the founder, or you, the leadership or management. And then in terms of any other personnel, if you have a finance controller, a CFO, maybe an accountant, and if you don't have, don't worry, you're going to do a budget yourself this time around, right? Okay, so in terms of frequency of the budget, I will just say that budget, you should try and do your budget every year, right? And start as early as possible. If, for instance, your year end is December, by September, you should already have started. Like, to the extent, I know you may say, hey, but it's too early. Yeah, it's too early. Well, let me also say this, that it depends on the complexity of your business. If you have a very simple business, maybe that may not be so too early, right? Maybe that's you can start anytime, maybe around December, early November, anytime. But try and start your budget very early, right? So that you don't get rushy, on what you want to achieve. And then your budget should actually be cover a period of 12 months, and then you can cascade your budget such that you can have, these are the things I want to achieve within the first 3 months, second 3 months, third 3 months, and the fourth 3 months. That's each quarter, right? And then for each of the quarters, you can say, okay, now this quarter, January, February, March, this is what I intend to achieve in January, in February, and in March. Now that helps you so that at the end of each of the months, you can look and say, did I achieve each of these things that I said I was going to achieve? That's very helpful. That's what a budget does for you, So in terms of budgets, how can you draft budgets? Let us try and do one. Well, I'm not going to be writing. I'm not going to be, I'm just going to tell you exactly how budgets work, right? Okay, so in drafting a budget, you can actually, like, what you try to do is to understand, like, everything about your business is just saying, where is the money coming from? Where is it going to? Do we need more money? That's exactly what your budget does for you. Where is the money coming from? Where is it going to? Do we need more? So, like, if you ask me to define your budget, that's exactly how I'm going to put it, right? So in terms of where's the money coming from, we're saying, what is your revenue? What is your sales? What is your turnover? Whatever thing you call it, your income. We aggregate all of those things together. Understand though that there's a chance that all of your revenue does not transition or to cash. So that's a different ball game. But let's just make this a very simple budget, right? So if you're able to understand where all of those monies are coming from, then you can say, when all these monies come, where do they go? Those become your costs. And your cost may be the cost of the revenue, which people call cost of sales or cost of goods sold or whatever name that you choose to call it. And then you can also have some other costs. For example, you can think about, you need personnel costs, right? Personnel, which is your staff, the staff strength. You can ask yourself, a few questions around that. And then other costs, rent, power, housing, all of those things, that you need, to run your business, operating costs, and then every other thing can follow on. So let's try and see if we can set, and design this budget together while we talk. The first element of your budget is actually trying to understand, do I want to do my budget from a bottom-up approach or from the top-down approach? Bottom-up approach is where you are saying, what is my targeted profits? So you're starting from a number that ordinarily should be underneath. You say, what is my targeted profit? And then when you know what your targeted profit is, whether it's you want to run a profit or a loss, when you know that number, you can now say, how much sales, how much revenue do I need to generate, and the cost associated with all of those things and running my operations in order to get to that target profits. That becomes your budget. However, most budgets are built from a top-down approach mechanism. Rather than going from the down to the top, most budgets are built from the top to the down, right? Now, what that means is that you say, what is my revenue? What are the costs involved? And then you can now arrive at your profits. That's basically what we're going to be doing in this particular one. So first and foremost is, you start by saying, where is the money coming from? Now, money can come from either operations or from maybe people who are giving you additional funds to fund your business, maybe your investors, or maybe other things. But these are the two major ways that a startup can fund the operations, either fund their business, either from operations. And from operation in this case is that you're selling stuff to customers and they're giving you money. And then the other part is to say, hey, what about those who are providing me funds, to bridge the gap that I have? But the essence of this thing we're doing now is to say, can we know if we need more funds? That's exactly one of the things that budgets will always help do. Now, again, remember I said this is a simple budget. So the first thing again is, where is the money coming from? Which is, what is your revenue? Now, in doing your revenue budget, what do you need to bear in mind? You can do your budget or your revenue budget in two ways. One is, you say, hey, I know that last year my sales was $1,000. If, for instance, the plan is to continue to grow at 20%, if I add 20% of my 1,000 to the 1,000, it will give me what? The budget for this year. That's simple, right? So basically you're saying, if I take 20% of 1,000, 20% of 1,000 is 200, and you add it to the 1,000 you had last year, it gives you 1,200. That becomes your budget for this period. That's one way to look at your budgets, where you're not trying to say, what are the things that bring this revenue and all of those things. You're just saying, I know what the income is, I know what the revenue is, I just want to grow it by this percentage. But you see, when you want to do maybe a more detailed budget, one thing that will be helpful for you is to understand, how do I make money? You make money by selling either a product or a service. So you can say, hey, what quantity of product do I want to sell this year? And at what price? That gives you your revenue, right? That's easy. Now, the complexity is that sometimes you don't just have to guess numbers. You need to look at, what did you do last year, right? And then, can you build on it? So last year, let's assume that you sold 100 units of your products, right? You sold 100 units of your product last year at $10. That's how you made the $1,000. But you see, business keeps changing. You may have acquired new customers, At the end of the year, you need to factor that into your budgets for this year. You may be thinking of acquiring other new customers as well, right? Meaning you also need to factor that in. You are thinking of conquering new markets. Maybe you want to get into a new market, a new city or a new country. All of those things will mean that your budget may increase. But what if you have lost some customers? That also means that it's going to impact your budget, meaning your budget may reduce unless to the extent that it is higher than the increase you're going to have from all of the acquisitions, all of the new customers, and all of the new locations you are going into. So, if you are able to understand that, okay, this is the quantity that I intend to, sell this year, whether you're selling goods or services, it's easy. Multiply that with whatever the price you want to sell this year is. Now, in terms of price you want to sell, don't forget that your price may actually change. So the price you sold last year may not be the same price you want to sell this year. So you need to be using the most recent price you're considering for this year in your budget. Now, how can that be? Because last year, if for instance you were selling at $10 per product, but prices have gone up, it means you need to actually factor that into your budget and raise your prices, unless you are maybe Father Christmas who want to dash people money, right? Otherwise, you need to raise the price. But if you have found efficiency, for instance, let's say there is a breakthrough in your industry that now makes you to produce your products at a very cheaper rate, right? What does that mean for you? If you so desire, you keep the money all in your pocket. Otherwise, you can share that with your customers. How can your customers share in your bounty? By reducing the price for them, so you can drop the price. Yeah, some of us will be happy. We are getting it cheaper, right? Okay, so all right. So now, so basically, if you're able to determine what your quantity or your volume, the volume of sales you want to do this year is, multiply it with the price you want to sell this year. That gives you your budget, your revenue budget. Again, there are also some nuances around this. For instance, you can actually do your budget such that the first 3 months or first 6 months will have a different price, and then the remaining 6 months will have another different price, or another price. That way, you're factoring the fact that things may change in the middle of the year. These are all of the nuances in budget. But basically, that's how you arrive at your revenue budgets. Now, the other part of your budget is your cost of generating the revenue budgets. Cost of generating the revenue. Now, depending on what business you are into, whether you're doing a product business or a service business, or you're doing trading or anything like that, your cost of generating revenue, which some people call maybe cost of sales or cost of goods sold or whatever name they call it, it's simple. You're just saying that this item I am selling, this is how much it costs me to produce, right? Per unit. Each of those units, each of the cost per unit, you multiply it by the number of quantity you want to sell that year, and you get what you get, your cost of generating the revenue, or cost of sales, right? Now, don't forget you need to factor in whether there is inflation during the period. If you're working in multiple locations, inflation differences in all of those locations, you need to factor all of those in. If you're a manufacturing business, you may be talking about the materials, the labor, and the overheads, right? The production overheads. All of those things will come together. You already have your bill of material, which they call BOM. You know how many units of each ingredient you use to produce every unit or every SKU that you're producing, right? And then you're now able to say, okay, this is the cost per unit of those items, and then multiply it by the quantity you intend to sell for this budget year. That becomes your budget, right? That's very simple. Now, even if you're in a service business, it's also the same way. Think about it. There are a few nuances around services budgets, but that's beyond the scope of this conversation. But there's nothing really any different from what we've talked about. Now, when you remove your cost of generating revenue from the revenue, so you take the revenue and you remove the cost of generating that revenue, which is the cost of sales, you get what they call the gross profits. Gross profits is to say, this is the profit that I generate profit I generate from selling from the items that I sold before any other costs of running my business. That's what the gross profit is. Now, there's what they call gross margin, which is the percentage of gross profit to revenue. It just helps you to know, okay, for every single item you sell, how much of it, how much of that, every single $1, $1, £1 that you generate, how much of it do you keep in order to make expenses and then to deliver to whoever owns the business, right? That's the profit, the main profit. So this one is the small profit, the other upper profit. That's, it's very important, but not, it's very important, but not super important. But it's very important because it determines whether you're going to have so much, underneath. Now, the other one is to say, okay, what is your staffing plan? Now, if you have decided that your business is going to grow, it actually means that staff may actually grow. So you can say, hey, do I need to hire more people? But you need to already know what your headcount was. How many people did you have the last time and how much did it cost you? You can say, what is the average cost per, staff? Then, how many new staff do you need to have? If you are planning to get into a new location, maybe a new city or new town or new village, then it means that you may most likely maybe set up a location there. You may set up your office there, or you may just have salespeople there. You need to consider that in your plan. Now, the whole essence of your staffing plan is to say, in order to deliver the desired revenue or the desired profits, how many more people do we need, or how many people in general do we need? So when you know the number of people you need, you now say, how many do we already have and how many do we need to have? All of those things are the things you consider. And then you can say, how much on average are you paying your staff? Based on that, multiply the number of staff with the quantity, or number of staff with the cost per staff, and then you get your staffing plan or your staff budget. That's basically that. It's just that simple, right? Making it easy, right? So, and then the other part is to say, okay, there are other costs that you use that are necessary for you to run your business. For example, you have an operational cost, right? Operational costs are just cost of running the everyday cost of running the business. For instance, you're going to pay rent, you know that you are going to buy diesel, or maybe pay for power, electricity, right, or gas, all of those things. And then you also probably have to run some marketing, professional fees, your accountants, and all of those things. You have to auditors, it's illegal and stuff like that. So all of these are the things that make up your operating costs. So most times this may be based on estimate, to the extent that you don't have maybe concrete plans with some of these people. For instance, you already know how much rent you pay, and in your rent agreement, most likely your landlord had told you that every single year you have to add maybe 10% or 5% or whatever percent, whether it's inflation linked or whatever it is. All of those things you may most likely have known. And then if you're going into a new location, you also see that you have to consider the fact that there is rent that you have to pay in those new locations, right? So that's how important it is. And so you can aggregate all of those costs. Now you can marketing plan. So most companies will tell you, I want to spend 1% of my revenue, or 2% of my revenue, or 3% of my revenue to generate more revenue. So based on that, you have your marketing plan. And then so all of those things are the things you aggregate, for the full year, and then you can cascade them back down into your monthly, budgets. And then you have your operating cost budgets. And once you have your staffing plan and then your operating cost plan, or your staffing budget and your operating cost budget, you can remove two of them from your gross profits, and then you get your net profits. Now maybe net profit or operating profit. Let's call it operating profit, because there are also other profits or other costs that may come. For instance, you have to pay for tax. Maybe if you have to pay for interest that you're owing people and all of those things. But let's just stop there. So you have your operating profit from your business, which is the profit that you have that you can use to settle maybe non-operating matters. For instance, paying for interest and stuff like that. Now, when you have this, you're very close to ending your budget. So, as I said, this is a very simple budget. Now, one other element of a budget is what they call the CAPEX budget, the capital expenditure investment or capital expenditure budget. Now, what am I talking about? Now, depending on what business you are running, you may necessarily need to inject or spend more money on certain things. For example, you may have to buy new machines. You may have to invest in maybe new technology and stuff like that. All of those things are capital in nature. They are things that if you spend money on them, then they will remain with you for a long period of time, beyond 1 year at least at a minimum. Those capex investments are necessary for you to continue to run your operations, for you to grow and stuff like that. So when you remove that, then that can help you to know what your overall net cash flow is, what exactly is remaining. you know Now, don't forget, as I said, this is a very simplistic budget, right? But this is basically the way that our budgets will basically be. So budgets are very important. Don't make them complex. They are very, very important because they can actually guide you in taking decisions around your business. So I hope this is very helpful. I hope you enjoyed this conversation. And please, if you have any question, don't forget to reach out to me. I'll be happy to answer. If you have any question, right, reach out to me. I'm very, very. I'll be glad to assist you if you so need such support. Thank you so much for coming to my channel again. I hope that you enjoyed this conversation, and I hope it's been helpful. Please just drop me a note, and please let me know what you think about this video. I hope to continue to make this a little more interesting. This is still early days for me in this space, but I know that over the next few weeks and months, I'll get better in delivering my contents, right? Okay, thank you so much. I appreciate it. All right, thank you. Bye from Finance Boulevard. See you next time.